Let me go across. We're joined by Gurmeet Chadha. He is from Complete Circle Consultants joining us. Great having you here, Gurmeet. Been a while. Talk to us. How are you looking at numbers? And do you expect the earnings momentum of sorts, the bit of upside surprise we've seen this quarter, can it last for the rest of FY27? Or is this a one quarter kind of, or 1 or 2 quarter kind of phenomena?
No, I think thanks for having me. I think
Great having you.
the momentum is well and truly back, and it's come back after I think almost 2-3 years now. Even if you see Nifty 50, if you remove the OMCs, I think the PAT growth is upwards of 15%. If you see BSE 500 as a whole, I think almost 490 odd companies have reported earnings. And I think if you take overall numbers, the earnings are looking pretty good, solid at about 18 odd percent. It's happened after a while, and I think at some point of time, it will reflect in markets as well. So the breadth of the market has been pretty good. It's largely Nifty 50 which is struggling thanks to HDFC, Reliance, IT, and few names. Also, I think if you see the basic macro and high frequency indicators, bank credit growth is 18%. Happened after, I think, 10-11 years. If you see direct tax collection, that's up 19-20%. GST numbers are up despite tax cut by 10-11%. So if you track most high frequency indicators, I think it's showing a pickup in economic momentum. In fact, I'll not be surprised if Q1 GDP numbers are closer to 7.4, 7.5. Real GDP numbers and nominal upwards of 11. So I think, let's see, I think overall things are looking good. And I think at some point of time, maybe second half of the year, hopefully the FI flows will also come back.
Good. But Gurmeet, afternoon firstly, looking at the index level, that doesn't seem to be reflecting any of that cheer. Outside the index though, I mean, the index has its own complications of weightage of sectors like IT and BFSI. Outside the index, where is it that you're finding investable opportunities?
Actually, I think few pockets are clearly doing very well. I think power equipment, capital goods is something which is looking very strong. Numbers are very good across the energy value chain, transmission companies, transformers companies, HVDC stations, etc. Their order books are full for next 2-3 years. So that's looking very good. Defense optically looks expensive, but I've been saying this, that it's a decadal opportunity. The defense export numbers will surprise. And a lot of companies reported very solid earnings. I think Solar Industries had very good numbers. Zen had a soft number, but now the orders are picking up on simulators as well as getting nods on newer categories. So this space is looking very good. I think tier 2 banks, mid-sized banks like Federal, RBL, look very, very good. I think October will even be better as FCNR deposits and low cost of funds shore up NIMs a little better. NIMs have been on a downward trajectory. Also, a lot of precision engineering companies. I think some really good work happening on R&D, whether it is Azad, Sansera, so many names. First generation entrepreneurs doing a very good job. And one pocket which has really surprised me the most is auto. I think Q1 is usually sluggish, but the numbers have been extremely, extremely good. You speak of tractor numbers, two-wheeler numbers, passenger vehicle numbers. I think a lot of auto ancillaries still are not reflecting the sustained momentum in auto numbers, and I think that pocket really looks juicy.
Gurmeet, I'm also curious to understand how you're looking at, you like defense, you like cap goods. What about the railways pack? Because if government spend were to hold up, which was a little bit of a concern at the start of this year with everything that's played out, if it were to hold up, the railway pack, which has seen a decent amount of re-rating, just given the time kind of consolidation we've seen, could well be something that looks interesting. Just wondering how you see it.
Absolutely, it does, and I think orders worth 30,000-40,000 crores are stuck across transformers, signaling, wagons, etc. I think it will pick up as oil prices normalize, as government shores up divestments, and I think even if you see the trade deficit numbers, looks like the CAD would be contained between 1 to 1.25%. It's not, the earlier concerns were the CAD will go up, and in fact we'll have a capital account surplus thanks to FCNR and ECB flows which are coming in. So I think and railway again is very structural. So we are playing more with the railway equipment makers than the wagon makers, etc. So I agree with you. It's just that you will have lumpiness which happens with any business to B2G business. That's what you need to be careful of. Take a more 2-year view and not a quarter-to-quarter view.
Gurmeet, I know you rarely talk stocks, but IT as a pack, how does that look to you? And Zaggle in particular, because certain product companies are typically going to do likely better versus your typical IT services companies, and therefore Zaggle surprising on the downside with regard to margins, this 7% kind of margin number, plus all the cash flow issues, the promoter coming and saying that they're likely to hike stake in the company. This was just a couple of months back. How does this story look to you? I mean, I'm not sure whether you're invested or not, but if you have a view.
No, so we're not invested here, but I've been saying this for a while that IT services, just because valuations are very appealing, you should not just go all out and buy everything. You have to be very selective. You said first part that focus more on IP and product companies versus plain IT services. So we are not completely out of IT. We have a little contra bet with small exposure to HCL Tech in the portfolio in large caps. A very small exposure in KPIT, considering the valuation art has come at after they revised the guidance. And I think Q2 should be better as auto numbers pick up domestically. And they lost a few contracts globally, especially in Europe, which affected. But it's a very IP-driven company. And some of the mid-cap IT names, we haven't added, but we are tracking Persistent, Coforge, both. I think that's something we would like to look at. I think the new age businesses should be in part of your digital portfolio. I think, like Eternal, Paytm, Grow, which is, the new age financial services company, something like Misho. I think this is where probably you'll get higher growth rates for much longer. And I think that's where we are trying to do. We probably have almost 7-8% weightage in our digital portfolio, which is more in some of these new age businesses, which are now pivoting and turning around.
Yeah, sure they are. And I think the earnings as well reflected that. But also, Gurmeet, a lot of primary paper is hitting the market. Will, of course, keep the market as well a little under pressure or abated. Anything that's interested you?
So, we like SBI funds. I think very tepid listing, and I think the stock is now below the IPO price. As I think today the lock-in has got over of 1 month, the anchor lock-in. It's the largest fund house, more than 12 lakh crore AUM. And as market picks up, AMCs have a beta play because the management fees is linked MTM. They've lost some bit of market share, with some performance becoming more quartile 2 in few categories. But that can happen with any large fund house. It happened with HDFC and ICICI earlier before COVID. It happened to them. But it's a very strong franchise. And it's a play on rising mutual fund penetration. And I think this looks at almost 30-40% discount to Nippon HDFC. So as market picks up, I think this is something we like. We are looking forward to the NSE IPO as an analyst. I think that's going to be another milestone event. And the one which listed today, the transmission company and auto component maker, I think that's something we are tracking. And there's another company coming next week, which is into facade for glasses. They make the glass facades. So that's something. So there are a lot of interesting names coming. And I think as market improves, you will see primary activity. But I think it's not close to what was there in 2025. So as long as supply is concerned, I think it's okay. Barring LIC, we've not seen a very big supply coming in.
Trying to get your take a little bit more, nudge you on KPIT Tech. They suggested that European demand is extremely sluggish or rather is not picking up. Do you see that as a structural problem? Of course, they're looking to fix it by going to different and newer geographies. But do you believe that European OEM problem could well be structural?
Partially, yes. And I think some of it is reflected in the price. And, you should appreciate management for being honest and coming before the earnings and indicating that. And but as I said, it's more a product software company. And Europe is obviously a large part, but I think they are diversifying and there are more labels which they are likely to add. And then we had the unfortunate event of the promoter passing away. So, look at all events and look at fact that it's available roughly around 20 times. The risk reward is good. I mean, and only when the news is negative, there is uncertainty, you will get a 20 kind of a multiple on names like this. Otherwise, it's always available at a premium. So, as I said, we've taken a very small bet. It's just that we don't want to be completely out of IT. And as I said, we will look at some names like Persistent Coforge also going forward. But larger IT services, largely, I don't see really they're doing more than 2-3% in constant currency terms. And for that, I mean, if you're paying 15-18 times, I think it's almost par for the course.
So, Gurmeet, are you still looking at these IT names from a tactical lens, or is it more like a structural buy and finding value at these levels?
No, hardly. Just 3-4% weight, Asha, as a tactically. I think stronger tactical call is banking. I've not seen bank Nifty at 11p, and look at. I'm a little disappointed what HDFC has been doing, but look at the valuations of some of the leading banks, SBI, HDFC, ICICI. Most of them. I think there's a lot of value here. And I think October numbers should, because the bank credit optic is pretty good, asset quality is solid. I think it sooner or later will reflect in the price action. There's been long consolidation in some of these frontline names.
Gurmeet, disappointed with HDFC with regard to performance, with regard to commentary, with regard to way in which things are going. What exactly is disappointing? Give us your take.
No, absolutely disappointed with everything. to be honest, I think look at that. They were 14.5 lakh crores before merger. It's come down to, I think, 11. I think I would have not imagined SBI at 10 lakh crore market cap and HDFC at 11 lakh crore market cap. But it has happened, and that's what tells you that market, you cannot take past performance for granted. I think the issue ailing with the bank has been less focus on core banking and more focus on third party and fee income. And that is getting reflected in poor customer satisfaction level, high middle level attrition in branch, which is almost 30%. And I think somewhere need to get back. I think probably take a leaf out of ICICI and see if they can. So ICICI did away with the bell curve, right? And focused on unit profitability and not product wise profitability. I think it needs a bit of a reset, and I think there's a lot of, I speak to a lot of my friends who have a lot of ESOPs, and just that when nothing moves, there's a bit frustration built in. So I think it needs a bit of a reset, but it's a very solid franchise, and I think at some point of time we'll come back. But I think the management now needs to get more aggressive. I think they've been very conservative. I mean, absolutely no synergy with the merger. The group, instead of focusing on credit, they've actually slowed things down to get liquidity ratios back on track. And if you're growing 11-12%, market will not pay you 3-4 times book. It will pay you 1.5, 1.6 book, which is happening. But I think it's some bit of maybe re-rating is down the corner. Fingers crossed. Happens to be a large holding for us, and it's given us a lot of pain.
We hear you, and we completely understand the pain, Gurmeet, but I just want to say that you're not alone. There are many out there who are crying those sour tears. But good to be speaking with you. Thank you for your time.
Pleasure.
Okay, that's Gurmeet Chadha on a whole host of stocks. Where is the market currently at? Still attempting to try and break into the green for the benchmarks, and it's pretty even-steven when it comes to the breadth of the market. We'll take a quick break and continue tracking markets on the other side.